can you explain what happened with the banks failing, and what is there more risk there, and what institutions are too big to fail and not too big to fail?
Yeah, so theoretically, no one's too big to fail. Trying to be careful about this one. So no one's too big to fail officially. But obviously there was a big shift from after the SVB and the other failures we saw recently. You saw a significant shift in deposits. This is not from proprietary information. There's journal articles about this. There's all sorts of things.
Yep.
You saw a lot of shift into the very, very large institutions because of the premise that they're too big to fail. Now, I think from a consumer's perspective, in many ways that shows kind of a lack of sophistication for most consumers, in that from your deposit perspective, your deposits are insured up to $250,000 per person per account type for banks, and it's a little bit different for credit unions. But still, even without thinking about it very well, someone who had a savings account and a checking account and an MMA account and whatever, they could have $1 million worth of cash sitting in an institution, and it's all totally insured. There's other products out there like CDARS and things like that that allow you to have unlimited amounts of cash that are insured through reciprocal deposit structures. But the issue with SVB was that they did not, their customers weren't taking advantage of that. There was a lot of reasons that, IT companies that were starting would go through them. They would help them get funding and all these things. And part of that agreement was then they had to have their deposits on balance. So they had a lot of uninsured deposits. It was like 80 plus.
Yeah, it was like 85%
It was an
plus.
absurd amount. Yeah. I mean, most institutions you look at, that blows out banks out of the water. I mean, that's unusually high. But then the other one that failed, same problem. And a lot of that was just these companies sleeping at the wheel, thinking, "Oh, okay, well, I'm not going to worry about it because, I don't think that this is going to happen." Well, then they did go under. There were products that could protect them. There were ways they could have protected those deposits. They chose not to. Yeah. But they were worried that the contagion from the fallout would have been so much that the FDIC chose to step in.
Is this something that we have to worry about, though? In your humble opinion, should we be worried about future banks and credit unions failing? Like, are we going to see a lot more of that?
Possibility that more would fail? Yes, I do. I think that you have, again, right now you have an interest rate risk challenge. They're trying to figure out how they can be profitable with all these legacy loans. You got to remember 2/3 of your book where that hypothetical institution we talked about are in fixed rate. So if you have a bunch of fixed rate loans that are sitting at 3.5%, even 4%, in a world where I can get a 3-month treasury bill at 4 and plus, then why would I have my deposits here unless you're going to pay me that rate, for one? So you see the cost of funds going up pretty significantly. But to do that, they have to start putting out loans at higher rates, but there's less appetite because these are really high. So you're having a lot of institutions who are stuck in a position of, well, I've got 30-year loans on my books, but the cost of funding those loans is more than I get in return from the loans. So they become structurally unprofitable. Now, there's ways you can work out of that over time. If they have a good capital position and they've thought about it, they have good contingency funding planning, all these other things, they should probably be okay. However, if they didn't, then there's a lot of room for challenge. And you see that we're already seeing those failures in a interest rate risk and liquidity risk world. You add credit risk into that, which is what's going to happen after all those reset variable rate loans start having issues, after all those white collar jobs that have lost employment the last few months. They're not paying their houses, they're not paying their businesses, whatever it may be. You're going to see a lot more of credits fail, and then all of a sudden their losses from the credits combined with the additional costs, combined with the low structural profitability for the lock, you just have a kind of a recipe for a lot more challenge. So short of the rates dropping precipitously, there will be institutions that are challenged. And the thing with bank and any kind of failure in a healthy economy, it's healthy. There will be a certain amount of failures that have to happen in a healthy functioning economy. Because if you just try to save everyone at any cost, you end up with a lot of, suboptimal change.
But it seems like they almost said the quiet part out loud. Like they would bail out the people that were too big to fail, but the little guys, the little credit unions, the little banks, they wouldn't. And that's where I was just like, hey, I wonder if there's a bigger agenda going on.
Well, I don't necessarily think it's an agenda. I think it's and I can understand that concern in that it does seem disparate. The treatment of one is not the same as the other. And I think someone did ask the press secretary, well, we've seen an outflow from smaller institutions. Are you going to be protecting these ones? And the answer was no, this wasn't a systemic risk for us.
Got it.
So I think that you have to balance the fairness of the financial rule with the reality of, but if I let contagion go, what's it going to do? And which ones do I need to look at and focus on for that? Because ultimately, all the regulators in the country combined, there's like 4,000 people who actually go into every single type of financial. I mean, there's not that many. That doesn't include states. I think states would add a lot to that number, and they do quite a bit as well. But still, I mean, you think about that compared to, that's less cops than there are in New York to manage all financial types of instruments and everything else around the country and even around the world. You have some other more complex things that happen with like the bailout of Credit Suisse and some other issues that happen with other countries playing around with some rules of bankruptcy that put a lot of uncertainty in everything for everyone. And now you have it's harder to find funding for banks right now because they chose to pay back when Credit Suisse went under. They chose to pay back the equity position before they paid back some of the debt that they had. And that's not how bankruptcy is supposed to work. So now the rest of the world took notice and said, oh, we may not get our money, even though historically bankruptcy would support us getting a flow of this. So a lot of people are a little apprehensive. I mean, you tag that along with, LIBOR's going away, new financial regulation, an election cycle. Like there's a lot of weird stuff going on all at once that makes this very challenging.
So for someone like you who is in the business of predicting recessions and all that good stuff, what is your predictions for 2023, 2024? Obviously, we're not holding you to anything. You're not giving financial advice.
All of this is entirely my opinion, exclusively as a private citizen.
That's right.
I don't think inflation is going to go down as quick as they want it to. I think that we're going to have more enduring, at least moderate levels of inflation for at least the next 2 or 3 years at a minimum. I think that we're going to hit a recession, probably, whatever their technical term they choose to, because they used to have a particular definition, they changed it. They tried to change it again. It's now whatever it is at the moment. But, from the perspective of, will we see 2 consistent periods of economic, of shrinkage in the actual economy, which is what I'll use as my definition. I think we'll probably have that by the end of the year. And I think that can endure for a while. I think it depends, though, if Congress gets into things and starts trying to legislate a fix to this, as opposed to kind of putting it all on the Federal Reserve to do. Because ultimately, the Federal Reserve doesn't have the tools all by themselves to fix the economy. You need to have rational people choosing to not spend money that we don't have, because then eventually it has to be printed from something.
Yeah. And are we going to see high interest rates, people losing their jobs, people having to fire sell their homes? Like, are we going to see that? Because it feels like it hasn't happened quite yet, but it's like once we take out all of our money, once we withdraw all of our savings, and then we start losing our jobs, even if your interest rate's at 2 or 3%, usually, like if one person loses their job, you're at risk of not being able to afford your home, and you can't sell your home for nearly the price that you want to. Do you see that happening?
I probably see some pockets of that happening. I don't think it's going to be as national as we saw in 2008. I think because we have such regional differences about real estate values, jobs. I also think that you're seeing a lot more flexibility where people work versus where they used to have to work, not in the big cities, everything else. But all of a sudden you could get into these B-level cities that depopulated 30 years ago. And you moved your, Tennessees and your Ohio's and your Pennsylvania, and all these places have these cute little towns that just like everyone left because there wasn't work. I can telework from there now. Maybe I can make it so that, if things aren't moving up as quickly, I can adjust to that. But I do think there's going to be additional, layoffs. There's going to be additional people who lose work, and ultimately you need to have that unemployment rate higher for a while to bring down that inflation number. So I think that you're going to experience some trouble. I also think more so, this is kind of outside of our topic, but I think demographics are your biggest challenge for valuations in the near future. Boomers are retiring at an alarming rate. But you look at the Generation X and the millennials that are below them, they don't have nearly the same levels of wealth as their parents did, as the boomers did during that same age. But additional to that, they don't even have enough to replace what the boomers have. So the boomers are getting into a position where they're going to have to start liquidating assets. They're leaving the workforce. A lot of them are going to say, hey, this is a huge hassle for me. I don't want to do this. But they start trying to sell those assets, those equities, those stocks, those things like that, real estate, whatever it may be. And they're going to find, oh, I have to sell to a generation without as much money. And they're going to have to drop prices until they can find a buyer because there's just not as much money chasing it. It's a macro level, or I guess maybe a sub macro level of inflation deflation that's happening between generational conflicts. In addition to that, I see a lot more costs for obviously the entitlements going forward, what we're going to play around with those, how that's going to adjust. I mean, now it's 9 years away that Social Security is going to be estimated to cut 25%. That's 9 years from now. And you think about how many millions and millions and millions of people are on that, what that's going to do to the economy. There's a lot of stuff coming down the pipeline that's going to be really interesting, more from a demographics perspective than from just the current recession.
I think Harry Dent was the person that had this whole philosophy around the market, not just based on like the S&P always going up, but just looking at the people saving money and then the people withdrawing money. And can we say, because the markets is essentially a Ponzi scheme. Essentially, like you need people that continue to fund into it.
It's kind of cash flows, but you hope someone's buying the next product. And if they're not, what are you selling?
Right. Yeah. I think inflation and stuff has kind of like put a little bit of ripples into that, because obviously we've inflated certain things. But the idea is the people that hold the wealth, when they stop saving and investing and they start withdrawing, will we as a generation be investing at a rate where it continues to grow? If you understand the markets are just supply and demand, it could be less on what's the perceived value of Microsoft and more about the pool of money and where is it going. So I hate to do this. We're running short on time. So I have one last question, unless you have an initial thought you want to say off.
No, I mean, I've definitely listened to Dent's stuff. There's several other demographers I follow and have just watched over the years. But I think it's an incredibly powerful observation, because I think that, especially for, getting back to what I do, regulation, you see a lot of smaller institutions where the demographics of their deposit base is also a challenge. You're going to see less and less small institutions, less so because they're not doing well or there's issues with them or anything like that. And again, this is not proprietary information. This is something you look up off call reports. But just talking with people at conferences and things like that, they'll talk about, oh yeah, well, I have a really old customer base. And every time one of these old people passes on, their kids just take the money and electronically transfer it out. The last time we saw a big deflationary cycle, which was pretty short and not that long ago, we didn't, this is 2001-ish time frame. You didn't have electronic banking. You didn't have the ability to instantly transfer money. You still had to go in and you were balancing a checkbook by hand. I mean, it was a nightmare at the time frame. I don't know how people lived through it, but you're not doing any of that anymore. And I think that people don't understand how much the velocity of money could have changed. And we don't really know what that is now, because we haven't had any reason to see big outflows in this way for quite some time. So it'll be really interesting. But I think demography is the next 10 years. I mean, that's what I'm paying attention to more than the microcycle of recession and not.